CNBC TV 18, celebrating 16 years of business leadership.
There's no stopping the fall in crude oil. Prices hit their lowest level in 6 years as the supply glut continues. Wall Street opens with caution as the US Fed decision on Wednesday looms large. European markets trade mixed. The dollar index gathers strength. A strong dollar rattles the rupee on Mint Street as the Indian currency hits its lowest level in 2 years. A roller coaster ride on Dalal Street ends with marginal gains. Retail inflation accelerates to its highest level in 14 months. Food prices are the major culprit, even as fuel prices remain largely stable. The Delhi High Court asked the government to decide on extending Cane India's contract within the next 6 months, says the centre cannot work in a vacuum. Finance Minister slams the opposition as he fears the winter session could be a washout. A meeting with the top Congress leaders fails to engineer a breakthrough. Top industry leaders set to meet with the Finance Minister on Wednesday to urge for the passage of the GST.
Let the telcos know if they don't improve, consequences will be there.
In his most scathing attack on telecom companies, Ravi Shankar Prasad warns of dire consequences over call drop, says it's not his job to find towers. That's a CNBC TV 18 exclusive. SEBI cracks the whip on Pearl Agro, attaches the assets of the company and its directors in the 49,000 crore rupee refund case. Car Dealers Association moves the National Green Tribunal, seeks a reconsideration of its order banning the registration of diesel vehicles in Delhi. Reserve Bank of India takes stock of the bad loan situation with India's top bankers, also discusses capital requirements and fundraising plans.
This is the kind of technology that the kids here at Startup Village are playing with, and this is what is inspiring them to come up with their own technology.
We run 122 hypermarkets, so everything in large setup is being provided to customers. So, and this is one of our unique things we showcase of Lulu is.
As far as Kerala is concerned, the major tourist attraction is the beaches.
That's what will very soon become Alua Station at the northern end of Kochi Metro Phase 1.
Well, God's own country is transforming into a haven for startups. CNBC TV 18 is inside Kerala this week to capture the thriving business scene in the state. Good evening. Thanks very much for joining us on India Business Hour. Hi, Nandara.
Hi, Shiri. It's been a busy Monday, and you've got to say the US Fed has also set the tone.
Oh, absolutely. They are setting the tone for what is going to be a Fed week right here on CNBC TV 18 and across global markets. The Fed is on everyone's mind, and crude prices getting rattled by a strong dollar, and that is our starting point tonight. Crude oil prices on a slippery slope. In fact, they've just hit their lowest level since 2009. NYMEX now slipping below the psychological level of $35 in trade. It has recouped some of those losses. 35.51 is where it's now trading, and Brent at 37.23. But prices continue to be under pressure. The dollar remains strong ahead of the FOMC meeting, and there is no end to the supply glut. So continue to see pressure on crude. On Wall Street, stocks are struggling to stay in the green. They have dipped into the red as we speak. It was a very flat opening for the US markets. Investors are sitting on the fence in anticipation of the Fed's rate decision. So that's the US market for you. 0.5% lower for the three indices. So will Janet Yellen bite the bullet or not? That is the big question, and this is the crucial week when the US Fed will announce its much-awaited rate decision. CNBC's Steve Leesman joins us now on what the market is expecting. Steve, what do you make of it?
So what we did is we went to our panel, 40 respondents this time around, and we asked them to put a number between 0 and 10 on how hawkish or dovish they were, 0 being most dovish, 10 being most hawkish, and we came up essentially with a CNBC Dove Hawk Index. Take a look at the current board. Let me just show you how to orient yourselves. 5 is right here, and Fisher and Lockhart are pretty much 5. They're the dead center in terms of the scale, and then you come all the way over here. Evans is the most dovish of the current voting members at 2.3, and then you see Jeff Lacker over here on his own at 7.8. Take a wide view now, and what you can see, if you take a look at it, is how the board currently skews to being more dovish than it is hawkish. Now take a look at the next board, and you'll see the 2016 committee, and what we have is we have these new entrants over here. Loretta Mester, judged to be more hawkish. Esther George currently would be, in 2016, the most hawkish of the voting members, and Jim Bullard. Goner, Lockhart, and Williams, and then you have Evans goes away, and Rosengren, slightly less dovish than Evans, but not much, comes in to replace Evans. So now take the wide view one more time, folks, and what we'll show you is that it's a slightly more hawkish committee. How much? Well, we can put a number on it, and what we had is we had a committee that, if you look in the middle there, 2015, it was a 4.3 on our 0 to 10 scale. Now it goes to 4.7. And there's some of the things that you see. Evans at 2.3, Lacker the most hawkish at 7.8, Governors 4.1, and there's Janet Yellen 3.7. I guess there's a question, Joe, should we have overweighted Yellen in terms of the index? We didn't do that. We took a straight average of our current voting members. So the question that you really want to know is, what does this mean for Fed rate hikes next year? We have the answer, but you're going to have to wait till tomorrow when we give you the full results of the Fed survey, Joe.
We've gone through this sort of situation where the market was thinking they were going to raise rates and that rate rise is off the table. Now it's been very, very well flagged. So I think they should follow through. And our US colleagues have actually been calling for a December rate hike now for 2 years. And they still expect the Fed to raise rates further in 2016-17.
Well, when we look at what the Fed's been saying over the last few weeks or the last few months, we think that all eyes are towards a rate hike in 2 days' time. You know, and we think this time around, yes, definitely they will deliver on par with what consensus think, because they've been saying that as long as the data holds good. So if you look at the recovery in the US, it's not very strong, but definitely, you know, the data has been there.
I think you're going to see perhaps some increase in Mexico, also in South Africa. I think elsewhere, you know, if we look at the story for Asia, we're not expecting interest rates to increase here. If anything, we'll expect some further easing in Chinese monetary policy. We've got record low rates in Korea and Taiwan. We think they'll keep them there. And what we're looking for at some point is both India and Indonesia have the potential to reduce real rates by cutting. But I think they'll wait to see whether there are big capital flows on the Fed move.
So on Wednesday, we'll know if the US Fed is going to hike rates for the first time in nearly a decade. Back home, let's head to the Lal Street. After a horror show last week, the bulls started off this Monday on a positive note. The day was full of drama with some wild swings. The Nifty gained about 40 points, and that's after swinging over 200 points. Onto the Sensex, that surged over 100 points. Both the major indices, in fact, managed to end with healthy gains. But that cannot be said for the rupee. The rupee has breached the 67 mark against the dollar. Market watchers were expecting the rupee to weaken ahead of the crucial Fed rate decision later this week. So we saw marginal losses, and the rupee going home at the lowest level since September of 2013.
But away from the markets, Nentara, let's talk about retail inflation, which has accelerated to its highest level in 14 months. In November, the consumer price index, or the CPI, stands at 5.4%, and that's thanks to food prices quickening more than expected. Lata standing by now with the analysis. Lata, prices rising for the 4th straight month. How big a concern is food inflation?
Well, yeah, first, why it is not a worry, that it would be the highest in 4 months. It should not be a cause of worry. November was always expected to rise to about 5.4% simply because November of 2014 was an unusually low number of 3.3%. So the base effect was going to anyways lead to a rise in prices. As well, the rise in food prices to some extent was expected because of pulses, that's 46% up year on year. The worrying part only is that sugar and oils and fats, largely edible oils, have caught on, but edible oils is globally a commodity that may come under control. Both these commodities not expected to see any runaway inflation. The positive part of the inflation number is that services inflation, non-food, non-fuel inflation has not risen much. In fact, in some categories like personal care as well as health, you're seeing either static or even fall in month-on-month prices. Even education has not risen much. That's been a niggling worry. So actually the services inflation has not risen much. It's usually in December that you see food prices falling. So we have to really watch out on Jan 12th or 13th when the December numbers come, whether inflation remains subdued. As of now, it's actually good news. You may see bond prices rise tomorrow.
The CPI at a 14-month high. Thanks, Lata, for joining us with that analysis. Meanwhile, wholesale prices slipped for the 13th consecutive month this November to negative 1.99%. Core WPI has also continued its negative trend so far. The mild increase was driven by food inflation, with vegetables and pulse inflation contributing the most. Now, the fate of the goods and services tax hangs in the balance as Congress MPs continue to stall Parliament. Rahul Gandhi sharpened his attack on the Prime Minister over a barrage of issues. He slammed Narendra Modi for allegedly asking Kerala's Congress Chief Minister Oommen Chandy to stay away from a Prime Minister's function in the state. The BJP hit back, saying there was no deliberate plan to snub the Chief Minister. Rahul Gandhi also claimed the RSS tried to stop him from emerging a temple in Assam.
And amidst this, the Finance Minister fears a washout in the winter session. In a Facebook post, he writes, and I quote, "The last session of Parliament did not function. The current session of Parliament is also threatened with a washout. The reasons for the washout of the current session keep changing by the hour. The question we need to ask ourselves, are we being fair to ourselves and the country?" End of quote. But the Congress in no mood to budge. The man appointed to lead the GST negotiations, Anand Sharma, hit back at the BJP, going on to say that the April 1 deadline is not sacrosanct.
Well, it's the government which is creating the issues. Its leaders, its ministers, by making statements which are objectionable, by serious and shocking incidents in the states ruled by the BJP. It's only a constitutional amendment bill which has still many windows open and many issues which have not been brought to an acceptable closure. And where is the hurry? 1st April is not sacrosanct. After this, you have to enact 3 central acts, this Parliament.
Well, that's perhaps the most damaging statement there from the Congress party. 1st April 2016 is not sacrosanct as far as the GST is concerned. Now, industry leaders all set to meet the Finance Minister on Wednesday. The delegation will include almost all industry chambers. I spoke with Sunil Kanoria, the Vice President of Shrey Infra and the President of ASSOCHAM, to find out what exactly they intend to put on the table in terms of concern. So the one big concern that industry has is the 1% entry tax, which the government seems to be favouring doing away with. And the other big concern that industry has is on the 40% demerit rate. It wants only a limited number of products or goods to be in the demerit rate basket. Let's listen in.
Well, the way it looks like, it doesn't seem so hopeful for this Parliament session because there have been continuous washout in the Parliament. It is pretty disappointing. Definitely to the industry. To our perspective, as we have said, for the economy has been going through a major challenge for many years now. And in order to revive it, the GST, to our perspective at ASSOCHAM, is the Brahmas to basically be able to revive the economy much faster. The reason is basically today to do business within the country is a big challenge. And that is what, if the parliamentarians look at and see the real problem in movement of goods and services between states, it's such a challenge, and it really impacts economic development and growth. And it is from that perspective.
So a mega meeting of industry and the Finance Minister on the 16th of December. Now, the Delhi High Court has given 6 months to the government to take a decision on extending Cane India's production sharing contract in Rajasthan. Ashmit joins us now with the details. Ashmit, this back and forth has been on for 3 years, and finally the Delhi High Court telling the government that it needs to take a decision.
indeed a rap on the knuckles as far as the government is concerned. The High Court making its message quite crisp and clear that the government cannot operate in a vacuum, that it has to take a call, serving it with a 6-month deadline. Now, at the heart of the issue is a production sharing contract that Cane India entered into in the year 1995, due to expire in the year 2020. And essentially, their prayer is that they are seeking a 10-year extension to that production sharing contract. Now, their argument essentially is, which they forwarded before the High Court, that the government is bound by the production sharing contract, that the PSC clearly provides that in case that there is commercial production, which there is, commercial production began back in the year 2009, in such a scenario, the government would then be bound under the contract to go ahead and to renew it and to extend it. The only subject matter that could be considered would be for what period. That's the bone of contention as per Cane India, that's the only issue that is open to discretion here. The government, of course, sought to defend its position, arguing that the only reason that the decision has not been taken yet is because sufficient and necessary documents by Cane India have not been made available. Now, this argument did not cut much ice with the Delhi High Court. The High Court held that the decision needs to be taken on a time-bound basis, that the government cannot operate in a vacuum, and towards that end, a 6-month deadline is now what the government is looking at, and that should add a certain degree of finality, certainty, as far as Cane India and its plans are concerned with respect to the Barmer fields in Rajasthan.
Okay, Ashpit, thanks very much for joining us. In fact, let's stay with that story. The chips are down, but Cane India refuses to go down without a fight. Cane's troubles include a crash in crude prices, a 20,495 crore rupee tax demand, a 3-year-long wait for the government to take a decision to extend its production sharing contract for the prolific Rajasthan oil field, as Ashmit was pointing out, and a pending controversial merger with Vedanta. Nentara travelled to Cane India's Rajasthan oil fields to check if Cane India has the appetite to invest more in the current scenario.
We're coming to you from the prolific Barmer oil fields of Cane India's and ONGC's in Rajasthan. Currently, the joint venture is producing 176,000 barrels a day, and it's got plans to enhance that a lot more. It's launched the Enhanced Oil Recovery Program, or EOR. Already, it's led to an incremental production of about 11%. Cane India has already invested $6 billion at Barmer to develop the country's largest oil-producing field. In the last 5 years, the company's paid $11 billion to the Central Exchequer and the Rajasthan state government in the form of royalties, duties and cess. And after 3 years of back and forth with the centre, Cane India has now moved the Delhi High Court to get clarity from the government on extending its production sharing contract for the Barmer fields. While you ask for timely extension, the government, and it's got the opinion of the Solicitor General as well, that it can revise the financial terms of this contract. We understand the Rajasthan government, and they're on record with us, that they want to increase the royalty that Cane India pays. How do you react to all of that? Are you interested in extension if the financial aspect of the contract will be rewritten?
The extension, it's not what I think, it's what the contract says. So this contract is very specific and unique, and it's very properly prescribed. And ONGC board has also been on the record that it should be extended for 10 years without change in terms and conditions.
After buying out Cane India from its former promoter Cane Energy, the Anil Agarwal-led Vedanta had promised former Prime Minister Manmohan Singh a daily production of 500 barrels. If Cane is to come even close to achieving that, it will have to rely on its recently launched Enhanced Oil Recovery, or the EOR program, on which it's already spent $500 million. In layman terms, EOR basically means getting every bit of oil out of a well. Imagine if your hands are dirty and you wash it with water, all of the dirt is not going to come out. But if you wash it with soap, all of the dirt should come out. And that's exactly what Cane India is doing with its EOR. I've got Divya here with me. So what Cane India is doing, and what I understand is, it's injecting 400,000 barrels of polymers every day in 141 wells. These, in fact, are the polymers. And if you look at the polymers that Divya showed me, very sticky, very much like soap, being used to get every bit of oil out of a well. While the recent crash in crude prices is weighing in on companies like Cane, the company says it's not perturbed and will continue to invest approximately $350 million annually till prices start to recover. In Barmer, Rajasthan, Nantara Rai. Well, now let's head to Deal Street. M&M and Tech Mahindra is all set to acquire a car design company, Pininfarina. An official announcement is expected, has come out a short while back. Farah Bukwala Voras joining us with the deal contours. Farah, What does this company do? And do we know what M&M and Tech Mahindra are planning to do with this acquisition?
Well, Nandara, this is a deal that was in the making for quite some time now. Pininfarina is basically an Italian car designing company, and M&M had been in talks with them for quite some time. However, the twist in the tale is that Tech Mahindra is in fact the forerunner as far as this deal goes, with M&M playing a smaller role. So basically, both the companies are coming together jointly to form a SPV in which Tech Mahindra will hold 60% and M&M will hold 40%. This SPV is going to acquire 76.06% in Pininfarina for 25.3 million euros. And for the balance, 23.94%, the SPV is going to make an open offer at €1.1 per share. Now, additionally, the SPV is also going to infuse £20 million into Pininfarina through a rights issue. So, for 100% acquisition of Pininfarina, the SPV is going to pay €53.3 million. Additionally, and this is the important bit, the SPV is also going to provide corporate guarantees of $114.5 million to lenders of Pininfarina. Now remember that Pininfarina has been loss-making for the past decade, and it has a net debt of €47.4 million as of September, and an EBITDA loss that it had made for the 9 months of this calendar year stands at €0.3 million. So for this particular loss, they are going to be offering corporate guarantees, and this is the important bit, because when we spoke to Vineet Nair, the Vice Chairman of Tech Mahindra, a little while ago, he said that Tech Mahindra will be bearing the entire cost of this corporate guarantee. So listen into that bit.
So this guarantee is being borne by us, and we have no problem about it being discharged. So by and large, our investment is around this amount. And as I said, 40% is M&M and 60% is us. I do believe that fair amount of that work, especially the engineering work, can come to India. So yes, if you look at next 2 quarters, perhaps yes, you're right. Okay. It's going to be negative. But then that is consistent with our strategy so far. We buy companies which are not doing great. We mend them, we bring in synergies, we bring in our capabilities, and we move forward with that.
That's the latest acquisition by Tech Mahindra and M&M, and Vineet Nair, they're saying this acquisition would be EPS negative for 2 quarters. Let's stay with you.
Actually 4 quarters, Nandara. They have clarified that it will be EPS diluted for at least 4 quarters.
Yeah. So those are stocks to watch out for tomorrow. But let's stay with the auto space. The National Green Tribunal's order banning diesel cars in Delhi has ruffled quite a few feathers. The Car Dealers Association in Delhi has moved the NGT seeking a reconsideration of this order. NGT will hear the plea against the blanket ban on diesel cars tomorrow once again. And like we were telling you, this ban on the sale of diesel vehicles has car makers worried, but some do see an opportunity that's waiting for them in the wings. Sonia Shenoy and Arundhati Ramanan get you that story.
One vehicle manufacturer's pain is another vehicle manufacturer's gain. So it is with the new National Green Tribunal order that bans the sale of diesel vehicles in Delhi till the 6th of January 2016. Delhi is an important market for passenger vehicle manufacturers, making up 7% of total sales in the category. So this ban could cut off 60 crore rupees in revenues. M&M will feel the heat the most. That's because its product portfolio is made up of only diesel vehicles. And Delhi accounts for 4% of the company's total sales.
The whole blame today is coming on diesel vehicles, and they are sort of made culprit for everything that is going wrong to the environment. I think a consultation will find a solution. The solution has to be done in a manner that we take in consideration all aspects and not just the air quality in Delhi, and not single out one villain, which right now happens to diesel vehicles.
Other car makers are a little better off, considering their product portfolios have petrol vehicles. Some, like market leader Maruti, Hyundai and Honda, hope the ban will push buyers to go in for petrol vehicles, thereby boosting sales in that category.
Structurally, I believe that it is the petrol vehicles that will be preferred by many agencies. And hence, I think Maruti Suzuki, which figures among our top picks, is a stock which obviously has a far bigger portfolio of petrol cars, stands to benefit the most in case I think the NGT order were to be implemented. And this will only be a cue for many other metros and mini metros, I think, where again the problem of pollution is equally acute.
Meanwhile, companies like Tata Motors are not expected to see a big deviation either way due to the ban. That's because only 4% of the company's operational profits come from its Indian operations. But the industry's overall state of panic is palpable for two reasons. One, there's no clarity on how this ban will affect the delivery of already booked cars. And two, the calendar year is coming to a close, and this only adds to the pressure on automakers to clear inventories as they gear up for the new year. In Mumbai, with Sonia Shenoy, Arundhati Ramanan.
And tomorrow will be a big day when the Supreme Court will take up the matter of diesel vehicles plying on Delhi's roads. Now, the market regulator has attached the assets of Pearl Agrotech, or PACL, and initiated recovery proceedings against the promoters and directors of the company. Naveen Shetty standing by with the details. Naveen, a mammoth 49,000 crore rupee refund case. Take us through the action taken by SEBI.
The capital market regulator SEBI has begun recovery proceedings against Pearl Agro and its promoters in a case of illegal mobilization of funds. SEBI has attached all assets including bank accounts, demat accounts and mutual fund folios of the defaulters. The recovery proceedings has been initiated as a result of the failure of Pearl Agro to comply by the SEBI order, which was dated August 22, 2014. SEBI had asked PACL and its promoters to refund rupees 49,100 crore to the investors along with the interest that was due within 3 months of the date of the letter. The capital market regulator had also directed defaulters to wind up the scheme soon after the payment to the investors. In September this year, that is 2015, SEBI had imposed a fine of 7,300 crore on Pearl Agro for illegal mobilization of funds. This penalty has been the highest ever levied by any regulator against any company in India. Back to you.
Thanks, Naveen, for joining us with that. That's SEBI cracking the whip, attaching assets of Pearl Agrotech. The RBI today met with India's top bankers to take stock of the bad loan situation. This meeting comes amid backdrop of the central bank mulling new rules for 5x20 scheme as well as the SDR scheme. CNBC TV 18 had reported last week about how the central bank wants to crack the whip on a few PSU banks that are flouting the strategic debt restructuring tool.
Global economy, commodity prices, IRAC norms, then comes the capital raising, all those things.
Capital raising, anything?
Yeah, no, nothing in particular that who will raise what. Have you got your plans in place?
Okay.
Just that. It was honest. It was absolutely, there was no set agenda.
CNBC TV 18, celebrating 16 years of business leadership.